Hi everyone, welcome to Impact Academy. I'm Yashasvi Chintada. Today let us continue with the Indian economic questions. So last session we have seen till the 10th question. Okay, so today let us continue with the 11th question. So look at the question. The concept of a poverty line in the form of jail cost of living in pre-independent India was first discussed by who among the following? So if you've already gone through Indian history, you see these names very frequently, right? Dadabhai Naoroji, what you said, the Grand Old Man of India, and you've seen R.C. Dutt, Ramesh Chandra Dutt. So one of the important book written by Dadabhai Naoroji is Poverty and Un-British Rule of India. Okay, that is see Dadabhai Naoroji books. Okay, see Poverty and Un-British Rule of India. This is very important book, even from history point of view or polity point of view. As frequently asked, Poverty and Un-British Rule in India, and Ramesh Chandra Dutt, RC book is also very important. Okay, um, the book written by RC Dutt is this one, The Economic History of India. Okay, these two are very important. So RC Dutt is Economic History of India, and Dadabhai Naoroji is Poverty and Un-British Rule of India. So if you look at, pre-independent India, Dadabhai Naoroji was the first to discuss the concept of poverty line. Okay, later on, we had several committees like Tendulkar Committee, etc. All those things. They're also very important from economic point of view. But in general, one of the first person to discuss the concept of poverty line was Dadabhai Naoroji, and he used the menu for a prisoner and used appropriate prevailing prices to arrive at what they called as jail cost of living. So basically, in the jail, he's looking at the what kind of food the prisoner is getting and what prices they are at, etc. And he came up with this jail cost of living. However, only adults stay in jail, whereas in actual society there are children also. So he adjusted accordingly, and he came at this jail cost of living poverty line. He assumed that one third of the population consisted of children, and half of them consumed very little, while the other half consumed half of the adult diet. Okay. So try to remember these points also because these days they're asking questions with what you say more depth. Okay, not one-liners or anything. And the weighted average of consumption of the three segments gives the average poverty line, which comes out to be the three-fourth of the adult jail cost of living. So who gave this jail cost of living? First of all, you have to remember it is Dalabhai Naoroji. And what are some of his observations? That in the prison he looked at the menu, etc., and the prices. But in the prison there are no children, and for children, what they have taken, some children do not eat at all, and some children take only half of the food. So, and three-fourth of the adult jail cost of living. So, he had taken the weighted average of all these three. So, who gave this concept of poverty line in the form of jail cost of living? So, it would be C, right? So, answer C. So, let us go to the next question. So, remember that Dadabhai Naoroji came up with that concept of jail cost of living. Fine. So, with reference to the fiscal policy, consider the following statements. So fiscal policy solely focuses on the quantitative aspects of raising revenue, spending money, etc. Anyway, so this is a easy giveaway. Fiscal policy solely focuses on quantitative. So always fiscal policy always focus on both quantitative and qualitative also. Okay. The channels for fiscal receipts include disinvestment proceeds, borrowings, taxes, and user charges. So disinvestment is, for example, if you take in Vizag, there is steel plant. Okay, it's frequently in use. So what the government will do is sometimes profitable institutions or sometimes not profitable institutions, they will sell the equity of the government to either a private or a private public partnership, etc. Okay, that is called as disinvestment. Okay, see. And also it's saying the Constitution in Article 112 explicitly mentions the division of budget into two accounts. And what are those two accounts? Revenue and capital accounts. Fine. So let us see. Fiscal policy encompasses not only quantitative but also qualitative aspects of public finance. So try to remember that. Fiscal policy. Any government will have a fiscal policy, right? So it will look at how we are going to earn money, how we are going to spend the money, what kind of taxes we are going to collect, what changes can be made. For example, if you want to bring out a new GST Act or anything, make some changes, reduce the tax on the individual, increase the corporate tax. All those are part of fiscal policy. Basically, what is the policy of the government when it comes to the finances of the country? Okay. So it is not going to just look at the quantitative. It is also going to look at the qualitative aspects of public finance. It includes whether it is through taxes, borrowings, or a combination of both, and quality of public finance, such as impact on capital formation, welfare, etc., etc. So all those are part of the fiscal policy. Remember, not just quantitative but also qualitative. So, the main channels for fiscal receipts include disinvestment proceeds, as we discussed right now, like what you say, I mean, selling away the equity of the government to private entities, etc., in steel plant or any other government organization, etc., say BSNL, borrowings from internal and external sources. So both internal, that is, it can be from the RBI or any market, or external sources. Like we frequently get loans from IMF, World Bank, etc. Right? So all those are they are fiscal receipts. And taxes, user charges levied for services like power, transport, water, etc. So we pay these municipal taxes, right? Water tax and the transport. When we buy a new vehicle, we pay the transport tax and all these things. Power, electricity bills, everything. All those are revenue for the government. So whatever taxes we are paying, everything is a receipt, fiscal receipt for the government. It is a kind of a what you can say non-tax revenue. Okay, tax revenue means it is in the form of taxes, and if it is not in the form of taxes, it is non-tax revenue. And it is talking about Article 112. So Article 110 is regarding money bills, right? That's also very important article. Article 110. Here is talking about Article 112. In Article 112, it does not explicitly mention the division of receipts into capital, I mean revenue and capital account. Now, if frequently when you read the budget or socio-economic survey, you come across these terms. What is revenue? What is capital? So, for example, to keep it simply, the government pays salaries to the employees, right? It pays salaries to the employees, and it see government is taking so many loans. Okay, so if you take suppose $1 million, you have to pay interest to the World Bank. So that interest is also revenue expenditure. So all these things which do not create any assets, they come under revenue. Okay, revenue expenditure, revenue receipts. Those things where some asset can be seen. Okay, that is called as capital. So, for example, if the government is giving money or it is building roads, okay, it is giving money to NABARD, say, and NABARD is giving it to banks, banks is giving to farmer to buy machinery, okay, that also comes under capital. So, even these grants or loans given to purchase some form of machinery or everything where you can see the asset, that comes under the capital account. And everywhere you cannot see the asset. For example, you are paying salaries to the employees. You don't see any visible assets. And if you look at defense, whenever a major chunk, around 7 to 8% of it goes to the defense directly, which is a huge amount. But this is very important. In the defense also, if the expenditure is for the purpose of purchasing some what you say machinery, missiles, okay, for ships, etc., that is again capital expenditure. Okay, don't get confused. Even under defense, if the expenditure is for the purpose of some form of asset, then it comes under capital expenditure. But if it is just to pay the salaries, pensions, and everything, then it comes under revenue expenditure. Okay, so that is the difference between capital and revenue. So that is something which is explicitly used every day. But Article 112 does not mention about this particular revenue and capital account. Then what does Article 112 mention? So what is Article 112? It is regarding the annual financial statement. Okay. So the president, in respect of every financial year, has to be laid before both houses of parliament. Statement of the estimated receipts and expenditure. Basically, budget, you can say. Budget is also one of the annual financial statement. So how much money we are getting, how much money we are spending, and that will be, I mean, the president will lay it before the both houses of the parliament. And estimates of expenditure embodied in the annual financial statement shall show separately. Okay, this expenditure will be shown separately. Sums required to meet expenditure described as the condition as expenditure charged upon the Consolidated Fund of India. So all this money, all these taxes, all these loans and everything will go to the Consolidated Fund of India. Okay, and whenever they want to charge something on the Consolidated Fund of India, then I mean, there is a certain procedure for it. You simply cannot. You have to pass a bill, a financial bill, and that has to get passed. Everything. Okay. So all that process is mentioned in Article 112. And what Article 112 mentions is the sums required to meet other expenditure proposed to be made from the Consolidated Fund of India, and it shall distinguish expenditure on the basis of revenue account from other expenditure. See, Article 112 is saying revenue and other. It is not saying revenue and capital. So that is the key difference. It is clearly saying that there is what is called as the revenue expenditure and there is other expenditure. But it is not specifically saying revenue and capital. In the question, he is saying it is mentioning about revenue and capital account. So this is wrong. Okay. So this is also wrong. Fiscal policy solely focuses on the quantitative. No, it focuses both on qualitative and quantitative. This is right. For fiscal receipts, okay, we're talking about disinvestment proceeds. Okay, by selling these investments, what we have, we are getting money for borrowings. If you borrow money from some World Bank or IMF, then that is the receipt, right? We are receiving money. Taxes, all the taxes are generating money, so the government is receiving, and user charges, all these. Any kind of toll tax and all these things. Fine. So, which of the statements given are incorrect? So, 1 and 3 is incorrect, right? So, it would be option C. Option C is the answer. Fine. So, now look at this. 30th question. In the given year in India, official poverty lines are higher in some states than in others. So, everybody knows poverty line, right? Tendulkar committee, and there are several committees, okay, which we have to go through. And we've already seen Dadabhai Naroji has given the first jail cost of living, poverty line, all those things. And he's saying that they are different in, okay, they are higher in some states than in others. Okay, okay. So statement 2 says price levels of commodities vary from states to states in India. So poverty is a state or situation in which a person or a group of people don't have enough money for the basic things they need to live. Okay, basic like food, clothes, etc. Okay, and poverty line is the required level of income to fulfill the basic necessities of life. It can be represented in terms of either per capita calorie intake or per capita consumption expenditure required to attain a minimum living condition. So, how much food you're taking, calories minimum that 2000, whether you're taking or not, or per capita consumption, whether you're taking, I mean, per person, the right amount of consumption. So, based on that, also poverty line is it is drawn. It is the required level of income, and it varies from rural to urban areas. Also, keep that in mind. And in this particular question, he's talking about one state to another. So it may vary from one country to another. Okay. And it may also vary from one state to another. So in Andhra Pradesh, there can be one poverty line. In Bihar, there can be another. In Tamil Nadu, there can be another. Like that. In India, due to the different price levels prevailing in the country. So the price of rice, dal, etc., can be different in different states. So the difference could be due to factors such as cost of living, economic conditions, and other regional variations. So, according to the UN, India has witnessed a remarkable achievement in poverty reduction. with a staggering 415 million individuals transitioning out of poverty within a relatively short span of time. So this is very important. From 2006 to 2021, United Nations is saying that 415 million individuals have transitioned out of poverty. So it's like, it's not, as you can see, it is 2021 means couple of years before, but this is like over a period of time. This is a very standard statement you see regularly. So it's very important. It can be asked in a question. So remember, how many people have come out of poverty? 450. So both statement 1 and 2 are correct, and it's the correct explanation. 2 is the correct explanation of 1. So that would be A. Option A would be the right answer. Right. So consider the following: customs duty, stamp duty, securities transaction tax, minimum alternate tax, and entertainment tax. So how many of the examples are indirect taxes? Okay, so now what is a direct tax? What is the indirect tax? A direct tax is one in which payment is made directly to the government by the one on whom the burden of payment falls. So the individual or the company paying the tax cannot pass the liability to anybody else. For example, if you talk about income tax, okay, so whatever income you have, whatever salary you have, so whatever tax you need to pay, you have to pay. That is a direct tax. If your salary is suppose 10 lakhs and you have to pay a tax of say 2 lakhs, 3 lakhs, that you have to pay. You cannot transfer it to anyone. And also corporation tax, these are some of the examples of direct taxes: income tax, corporate tax, minimum alternate tax. So minimum alternate tax is, for example, if you have a company, they say my company headquarters is not in India. Okay, it is in Maldives. So I'm not going to pay tax because whatever profits I'm getting, those profits I'm sending back to Maldives. So for that, in order to avoid that, government has come up with this idea of minimum alternate tax. Okay, so you are going to send all your profits to. Okay, see, in this particular case, if you're sending to Maldives and all, what happens is that is called as money laundering, etc. But if you say genuinely, also suppose there is an American company, okay, they come and do business here. Even many companies like today, say anything Toyota, okay, it's a foreign company. It's a genuine company from Japan. So if some of those imported cars or whatever it may be, the what you say the profits which they get, they will obviously go back to Japan. Okay. So in order to avoid that, in order to lose tax revenue, government comes up with this concept of minimum alternate tax. Okay. So you need not pay this whole corporate tax on your profits, but at least pay this minimum alternate tax. Okay. Fringe benefit tax, dividend distribution tax, especially if you're looking at stock exchange, trading, and all those things, these taxes are very prominent. When the company gives dividend, okay, dividend means every now and then, suppose you have 1,000 shares, and if the value of each share has increased from 100 to 200, then say 1 rupee or 2 rupee or 10 rupees is given as dividend, okay, because the stocks are doing well. So on that also there is a tax, securities transaction tax. So whatever trading you do, you buy stocks, sell stocks, all those things are security transaction tax. Now in security transaction tax also there is a lot of content, there are a lot of kind of questions can be asked. Okay, uh, for example, in the stock market you are dealing with these things, okay, government bonds, securities, all those things, okay, preference shares, government bonds, and all those things. In such a scenario, you need not pay security transaction tax. And also, for example, if there is a takeover, if there is a takeover, some company is taking over some other company. In that case, what will this company, this big company which is taking over, it will buy all the shares of the small company. Okay, there it is buying the stock, but it need not pay this securities transaction tax because it is happening in a different way. They are not doing trading, so they are going to pay other taxes for the takeover, etc. So they need not pay security transaction tax. I think you understood, right? Only this regular stock market trading, this buying and selling of shares, all these things, you will have this security transaction tax, not for compulsory, mandatory, or government bonds, etc. So capital gains tax, angel tax. Okay, angel tax is investments. Okay, when you make in startups, etc. When you invest, that is angel tax. Okay, property tax, all these things. These are direct taxes. So indirect taxes are those which are levied on manufacturing, importing, or sale of goods. For example, most important indirect tax is recently GST. Okay, so central excise duty, customs duty, VAT, entertainment tax, stamp duty, etc. They're all indirect taxes. They are not directly paid by you. Okay, so it's not like see, direct taxes are on a particular company or on a particular person. So you have this much salary, you pay direct tax. This entertainment tax and all those things, they are not direct taxes. You don't pay entertainment tax, right? You don't pay stamp duty and all these things. When you purchase an item, for example, you don't pay the GST as such. The manufacturer, the person who is manufacturing it, he pays the GST. Okay, of course, you whatever you pay in the MRP, GST is also included, but normally it is not a direct tax because it is not directly being paid by you. Okay, so consider the following: customs duty, stamp duty, SAT, MAT, entertainment tax. Which of the following are indirect taxes? So all are indirect taxes, right? One, let us see one, two, and five only. One, two, and five. Okay, so I'm sorry. This just now we have discussed, right? Security transaction tax and minimum alternate tax. So we have seen this minimum alternate tax is almost like a corporate tax. When you have a corporation in India, they pay corporate tax. When they're sending the profits back, instead of paying full tax, they're paying a minimum alternate tax. And securities transaction tax also, whenever you do the stock exchange, buy and sell shares. Okay, so that is a tax that is directly levied. So in this case also, security transaction tax and minimum alternate tax are they are examples of direct taxes. So one, two, and five. So one, two, and five are indirect taxes. Fine. So consider the following statements: lower inflation in goods and services, more focus on capital intensive ways of production, urban bias in private investment. How many of the above are causes of income inequality? So now let us look at what is income inequality. The gap in income between the rich and the poor is referred to as inequality. Okay. In other words, it indicates the disparity in the distribution of economic assets and income. So obviously, the rich will have a lot of assets and income. The poor will have less assets and less income. Then that is called the what you say income inequality. Now, the first option is saying lower inflation in goods and services. So what is meaning of lower inflation in goods and services? For example, today you have rice is 50 rupees. Okay, tomorrow if there is rice of 60 rupees, okay, that is say lower inflation. Or tomorrow if the rice becomes 100 rupees, then it is high inflation. Okay, little bit rise in the price is low inflation. If the prices are increasing at a very high rate, 50 is becoming 100 suddenly, then it is very high inflation. So it is relative, of course. I mean, not exactly. If you say 50 rupees becomes 60 rupees, you can say that is also high inflation. But I'm saying generally. So basically, low inflation, high inflation. So what happens if a rich person, whether the rice packet is 50 rupees or 100 rupees, it doesn't matter to him. It is same. But for a poor person, if the rice packet is 50 rupees, it becomes 60. It is a burden on him. But if the 50 rupees rice packet becomes 100 rupees, then it is definitely a very high burden on him. So low inflation in goods and services is, of course, inflation is definitely one of the reasons for income inequality. Okay, but in this case, high inflation, high inflation causes more inequality, right? For a poor person, 50 rupees suddenly becoming 100 rupees causes more damage. So in this case, this is the wrong option. Lower inflation does not cause too much inequality. Only higher inflation causes too much inequality. Next, more focus on capital intensive ways of production. That is, if you are suppose there is a factory, you have 100 people working. But in capital intensive production, what happens is you buy a fully automated machine, say 50 crore machine, okay, and that machine will do all the packing, sorting, packaging, everything. Then what you will do, you will remove around 80 people from jobs. Okay, only 20 people will be there, and rest of the work will be done by this capital intensive way, that is machine or something. So what is happening? Poor people are losing their jobs. So because of that, the inequality is increasing. So More focus on capital intensive ways will definitely increase income inequality. Fine. Urban bias in private investment, obviously. See, anyone, most of the private investment they want to do in cities. Okay, if you want to put a new hotel or a new mall or anything, I mean, if you want to suppose there are private buses. Okay, if you want to bring a new bus service, new taxi service, everything, you are going to focus more on urban areas. Okay, so this is giving more facilities in the urban area than the rural area. So that is also increasing income inequality. So see, option one, inflation can disproportionately affect the lower income individuals. Okay, see, inflation in general is bad for everyone. Inflation in general is bad for the poor people, but because they spend most of their income on basic necessity like food, housing, and healthcare. So when the prices of these goods rise significantly, it can lead to reduction in the real income. Okay, so higher inflation, higher inflation provides for more income inequality. So in this particular case, lower inflation is not that bad actually. Little bit of inflation should be there in any economy. Otherwise, there won't be the development will also stagnate. The growth will also stagnate. So option two is correct. Capital intensive production. Okay, any machinery technology you bring in, and what happens is most of these laborers etc. they lose jobs, and the income inequality widens. Okay, an urban bias in private investment. Urban bias in private investment means that more investment is directed towards urban areas and industries, neglecting rural areas. So that is also one of the reason why it is happening. Okay. So what happened in this particular case? How many of the above are causes of income equality? Two and three, right? So it is option B. That is only two. So which are those two? Those two are this one. 2 and 3. First one is not the option. If this would have been higher inflation, then this is the right option. So let us look at the Gini coefficient. First, let us look at what is Gini coefficient. The Gini coefficient or Gini index. It was developed by the Italian statistician and sociologist Corrado Gini in 1912. Okay, it measures the degree of income inequality in a country. Degree of income inequality by calculating the ratio of area between the diagonal line of perfect equality and the Lorenz curve divided the anyway you don't need to remember all this Lorenz curve and all these things that comes under microeconomics. So usually so many questions will not be asked from microeconomics. Mostly macroeconomics is more important. Okay, even if they ask too many questions in microeconomics, you will not be able to answer. So it's fine. No one will be able to answer. So no need to go into that depth unless you are doing MA in economics or anything. So what is Gini coefficient? Basically, it is from 0 and 1. 0 means perfect equality. That means everyone has the same money. Okay, no rich and poor. On the other hand, 1 means perfect inequality. That means the poor are very poor, rich are very rich. So that is what 0 to 1. Okay, the higher the Gini coefficient, that means as it approaches towards 1, that means gap between the rich and poor is increasing, right? 0 means all are equal. 1 means all are very extremes. So as the Gini coefficient increases from 0.29 to 0.36 to 0.5676, as it increases, it is showing a higher level of income inequality. So what it is saying, it measures the degree of inflation in a country. That is wrong, right? It is not measuring inflation. Okay, it is measuring income inequality. The higher the Gini coefficient, lower the gap. It is no, it is the higher the gap. As the Gini coefficient goes from 0 to 1, the gap is increasing between the rich and the poor. So which of the following are correct? Neither one nor two, right? Okay, D. Neither one nor two. Fine. So consider the following statements with reference to Indian economy. Non-tax revenue receipts include, okay, we're talking about revenue, all these things. So let us look at what is what. So non-tax revenue receipts. This includes all money earned by the government from sources other than taxes. So we have seen direct taxes, indirect taxes, right? Income tax, MAT, SAT. GST, all these things are taxes. So that which comes not from taxes. Okay, what is that? Profits and dividends from government. For example, PSU. PSU means we can say either government banks or say steel plant or ONGC, etc. Okay, so those are all government entities. So when they are government entities, whatever profits they make, okay, that is also a form of revenue for the government, but it is not in the form of tax. So that is called as a non-tax revenue. Similarly, interest received by the government out of, for example, we are giving loans to Sri Lanka, Nepal, and all these countries, right? So when we give the loan, they are also going to give back the interest. So that interest received is also part of non-tax revenue. Fiscal services, okay, currency printing, stamp printing, etc., coinage, metal, all these things. General services, power distribution, irrigation, banking, okay, banks also. Whatever profits the bank makes, that is indirectly the revenue for the government also. I'm talking about the government banks, okay, not ICICI or HDFC, PNB or Union Bank, etc., all these banks, SBI. So whatever profits they make, indirectly, this is revenue for the government, and it is not in the form of tax. So these are all taxes, fees, penalties, fines, everything. So all these fines, okay, you spit on the road, you get 200 fine, and all these things, all these fines, penalties, fees, everything, they are all income to the government. Grants which the government receives. Okay, even these grants which, in the case of central government, internal in the case of state government. Okay, for example, recently Britain there was some issue also, right? Some British journalists made comments that if India has a successful space program, why is it still getting grants from us? All those things. Anyway, it happens. These developed countries are giving grants to developing countries, India, and they're saying like they're also doing not for charity only, they want to give grants so that we develop, and when we develop, more and more people develop, for example, and once you get more income, you will start buying expensive things. You will buy these expensive imported perfumes, bags, and etc. Okay, so that is why they are giving. I mean, that is their reasoning. The reason we are giving grants so that developing countries can develop, and it will have a market for us for our products and services. And they want educated IT employees and all these things. So that is the reason they are giving grants even now. Okay, revenue account, revenue account expenditure includes but not limited to interest payments, defense subsidies, public administration, financial grants to states. Okay, all these are revenue expenditure. Revenue expenditure means that where you cannot see the result, you cannot see any asset or anything. Okay, all these interest payment, whatever loans we are taking, we are doing interest payments, subsidies also. Okay, subsidies, public administration, financial grant to states, all these things. It does not create assets. Okay, very important. So all non-revenue receipts of a government are known as capital receipts. So if it is not revenue, then it is capital. Such receipts are for investment purposes only, okay, and supposed to be spent on planned development by the government. Capital account receipts involve recoveries of loans. Okay, see, many people get confused, especially those who do not have any, not, I mean, exposure to banking. What they think is loan is a, what is a loan is a, uh, for example, if you put money in a bank, okay, if you put FD or a savings account, you have 1 crore rupees. What people think is that is an asset. That is an asset for the customer or for the citizen. But if you look at the point of view of a bank, then that is not a what you say asset. It's a what you say, it's a debt for them. Okay, it's asset. Just a minute. Let me check the word exactly. So it's a liability. Okay, it is called asset and liability. So why it is a liability? It is a liability because if you have 1 crore rupees in your account, okay, for the bank that 1 crore rupees at some point of time they have to return to you. Whenever you ask for your money, they have to give it back to you. So it is a liability for them. On the other hand, if the bank gives you a loan, okay, you will have to pay interest. So when you're paying interest, that is generating revenue for the bank. So the what suppose the bank gives you 10 lakh rupees as a loan, it is going to get back its 10 lakh rupees, Also 1 or 2 lakh of revenue interest. So when the bank gives a loan, that is called an asset for the bank. Okay, so that is where many people get confused. When you deposit money in a bank, okay, the bank is taking money from you. So, but that money has to be returned at some point of time. So that is a liability. Fine. So capital account receipts involve recoveries of loans. That is also whatever loan you have recovered. That is also part of a capital receipt, not revenue. Receipts from asset sales. We have seen, right? Disinvestment, steel plant, and all these things. Fresh borrowings from inside and outside the country. So if the IMF or World Bank gives us, say, 100 million, 200 million, all these things, they are all part of the capital receipts. Okay, because World Bank will not give you millions to pay your salaries or anything, right? They will give you all this for infrastructure. Okay, they want you to create some sort of infrastructure. So, non-tax revenue receipts include profits, interest receipts from loans given, and dividends from entities like PSCs. Okay, so all this is the non-tax revenue, right? Fine. Revenue expenditure, if done by states, directly create no. Revenue expenditure is states giving their salaries, pensions, and all those things. That will not create any assets. Capital receipts involve recoveries of loans. Fine, that is capital receipt, receipt from asset sales, and fresh borrowings. So all those are correct. Which are correct? 1 and 3 is correct, right? So option C. Okay. So these are the different types of unemployment. So what is structural unemployment? This type of associated with the economic structure of the country. Now, economic structure implies rapidly growing population, slow rate of capital formation, etc. Now, what that means is, for example, if we have 20 people today who are going as daily labor, okay, and if the person who is building a building, he wants labor, say 20 people, they are asking for each 1,000 rupees. He will give 1,000 rupees and he will take 20 people. Tomorrow, if there are 50 people, but he needs only 20 people, okay, then he is not going to pay 1,000 rupees. He'll say, I will take only those people who will work for 500 because there are 50 people and they all want work, but the work is there for only 20 people. So they will say, even if you give 500 rupees, I will come. Okay. So that is structural unemployment. See, population is growing. Okay. Capital formation is reducing. So many people are unemployed. Because of this structural thing, they are unemployed. That is called as structural unemployment because of rising population and the slow rate of capital formation. So this type of unemployment is also called a skill shortage. Say if you are looking for a welder, you want 20 welders, but there are 50 labor available, but only 10 people know how to do welding. Okay, so that is also structural unemployment. So this type of unemployment is long term in nature. Okay, this is also very important statement because it is not going to change overnight. Okay, 50 people are not going to become 20 again, or this 10 welders are not going to become 30 welders in a short period. In order to skill them or create capital formation, all these things, and control the population, it takes a lot of time. Okay, so this is long term unemployment, structural. So tomorrow there might be a statement which says that structural unemployment is long term unemployment. Okay. Next, frictional unemployment. What is frictional unemployment? Unemployment here is generated by changes in market conditions. Some workers are temporarily out of work due to strikes or recently we've seen COVID, right? Because of COVID, many people have lost jobs temporarily. So frictional unemployment is temporary. This is long term. This is temporary. What is disguised unemployment? See, marginal productivity of labor. What it means is, for example, um, there is a job which requires two people. Okay, suppose in a construction building, they are laying the floor. If there are two people, one person cuts the cuts the tiles, another person is laying the tiles. So what you will do is the what is it, the contractor He has five people available. So what he will do is he will put five people on the job. Okay, even though if two people are enough, because five people are available, and due to some relation or because today if he gives them work, tomorrow they will come. Okay, so there will be several considerations. So he puts five people on the job. So tomorrow, if he feels that five people it is costing more money, he will remove two people and he will put three people on the job. Okay, so even if he removes two people, still it doesn't make any change. So that is called disguised unemployment. So if a person does not contribute to the production process, okay, if he or she can be removed from work without affecting productivity. So out of five people, even if you remove three people, still two people are enough to lay the floor. So that is what is called as disguised unemployment. Similarly, so marginal productivity of labor, what it means is similarly two people are enough. But if you put three people, work will become more faster. Okay, the two people will have an extra hand. But if you put four people, maybe one person is just sitting idly. Maybe he's just moving around, carrying here that. But his marginal productivity is zero because whether he is there or not, it doesn't matter. Okay, even if you remove him, it doesn't matter. Fine. So it's a common phenomenon in developing or less developed economy. So if you go to any construction activity, you will see this. Out of 10 people working, one or two people will just do time pass. Okay, their marginal productivity is zero. Okay, so they are having disguised unemployment, which is actually risky because he is having job, he is getting money, so he thinks it's fine. So any moment he can be removed from work. So structural unemployment caused by skill shortage, okay, it is long term and all these things, growing population, less capital formation, all that. Frictional workers temporarily out of work, which is correct. So disguised marginal productivity of labor is zero. All are correct, right? All three. Answer C. All three are correct. So consider the following products: alcohol, petrol, aviation turbine fuel, natural gas. How many are under GST? So GST is very important. 2017, right? GST Act. It subsumed central indirect taxes. Okay, GST is not a direct tax; it's a indirect tax, and it's subsumed. That means it has taken into its ambit all the central excise duty, additional duties, service tax, VAT, all these things. Octroi, customs, several duties, and central sales tax, entertainment tax, octroi, all these things have been subsumed by GST. But alcohol, petrol, diesel, okay, aviation, turbine fuel, natural gas, etc., they do not come under GST. Very important. Previously, cement was also there. I think now cement is removed. Anyway, so alcohol does not have GST, petrol, diesel, basically petroleum products, aviation fuel, all these are what you say energy, right? Energy related. So alcohol, petrol, all these things, all four. So D will be the answer. All four are outside the domain of GST. D is all four is the option. Fine. So this is the last question for today. Which of the following is not a limitation of the market economy? So let us look at what is market economy. So if you look at any economy basics, you will get all these things. Adam Smith, laissez-faire, all these things. So Adam Smith is a very prominent one of the early economists. Okay, he's a philosopher and economist. Okay, he's from Scotland. So what he says that, and this book Wealth of Nations is very important. Okay, Adam Smith Wealth of Nations is very important. So what he's saying that uh, all premises run of self interest. That is, there is a businessman. Okay, he has some self interest. If he produces, suppose there is a soap manufacturer. If he makes 10 soaps, he's getting each soap he is selling at 10 rupees. So he's getting 100 rupees. So he will say, what can I do to get 100 rupees? Okay, what can I do to get 1000 rupees? Increase the number of soaps. Okay, increase number of labor. So slowly increase machinery. Open one more factory. Okay, so it is the self-interest of the individual or the firm which motivates him to do more economic activity, and because of that, 10 soaps, 100 soaps. So more people are getting soaps, and when there are more soaps, the prices will reduce. So society is also getting goods and services. So this is all part of the market economy. He's saying that it is the self-interest of the people. They are doing more business. People are getting benefit out of it. And he's saying there is an invisible hand, often called as the animal spirit, which is driving this, motivating this person, the business person, to do more business. For this, he is saying that there has to be a force of demand and supply. Suppose if more and more people are using soap because there is good quality, less price, more demand will be there. More demand means they will increase the supply. Okay, you will increase the number of machinery, labor, etc. So more income is generated, the economy is growing. And he's saying for this to work efficiently, the government should follow a policy of laissez faire, very important. That is non-interference. So these are called as market economies or capitalistic economies. On the other hand, you have this communist economies, okay, what you say, where there is complete government interference. Okay, so in India also, until 1991, of course, you have a mixed economy, but private participation was very low. You have this license Raj, okay, all these industrial policies, all these are very important. Today, you have a mixed economy. That means government interference is there, but it is very minimal, and there is a free market also. So India, we have a mixed economy. But Adam Smith is talking about a market economy where he wants everything to be free and fair. Okay, no government interference, demand and supply, self-interest. All these are very important. Okay, but what are the limitations in such a case? There was almost no tool to look at the lower purchasing power. So suppose there is a good demand. Each soap is say 10 rupees. Okay, slowly the soap became 30 rupees, 40 rupees. Okay, now the poor people are not able to buy. But as long as there are sufficient rich people who are able to purchase for 30 rupees also, the person who is doing the business, he is not going to sell for 10 rupees. He will say, if people are buying for 30, I will sell for 30 rupees only. So the poor people are getting affected because there is no government interference. So in case of a market economy, there is no, what you say, tool to look after the poor, and negligible to the total absence of welfare action from the state, because there is no, you see, laissez faire, that is no interference from the government. Because there is no interference from the government, there is also no welfare action. So government is not going to come and say, okay, I will also produce soaps for 10 rupees so that the poor people can buy. Okay. Now this is what happens, right? Government is coming up with this new brand of rice called Bharat rice. So when the rest of the rice are about 50 rupees per kg, government is giving it 24 or 25 rupees per kg, something. Bharat brand of rice, wheat, etc. Okay. So that is, it is giving a welfare action from the state. So in Adam Smith's market economy, that is missing. Okay, widening economic inequality. Obviously, there is going to be economic inequality between the rich and the poor because there is no control. Okay, the prices also. Progressive taxation. The rich are taxed high rate. For example, if you have 10 lakhs, your tax rate is 10%. Suppose you are earning 30 lakhs and above, your tax rate is 30%. So that is progressive taxation. As you become more rich, you are taxed at a higher rate. So the scarcity of investable capital is a limitation of the non-market economy. Okay. So in a non-market economy, as the systems aim to serve all, and there is no idea of creating capital or wealth. So if you look at in Havana, sorry, Cuba, when they got liberated, the government had taken over all these factories and everything that were established by the United States. Now the government says that, okay, in this factory we will produce 1,000 products, and irrespective of whatever the demand or cost, each product will sell at 100 rupees, so everyone can buy. Okay, in such a scenario, no businessman is going to come forward and say that, okay, I will take a loan, I will open a factory, I will do business like that. Okay, so there is going to be scarcity of investable capital. People will stop investing. Okay, they'll say, okay, if I purchase, if I whatever I do, my profit will be the same. So slowly he will stop. He will stop losing interest. Okay. Anyway, so there is going to be a scarcity of investable capital in a non-market economy. But if it is a market economy, people have this self-interest because the more hard work they do, the more business they do, more money they get. Okay. So which of the following is not a limitation of market economy? So in a market economy, there is no tool to look after those who have lower purchasing power. So there is basically no help to the poor people. Negligible to the total absence of welfare action. Yes, there is no welfare action from the state, and that leads to widening economic inequality. Okay, fine. But investigative capital will be there. More and more people will be ready to do business, to invest capital. So the scarcity of investment capital is what is a feature of the non-market economy. That is a rigid economy, like in the case of some of these communist countries, etc. Okay, so it is option D. Answer is option D. Fine. So let us stop here for today. Okay.